This is the question most financial advisors do not answer directly. Did you know what you were told about protecting your money was incomplete? Why did bonds fall the same year stocks fell in 2022? Who collected management fees when both fell? And when does bond protection actually work? This video is for educational purposes only and does not constitute financial advice. Always consult a qualified financial professional before making any investment decisions. I spent 3 weeks explaining bonds to my sister May. She asked, "Are they safe?" I said, "It depends." She said, "I will Google it." One correlation, one mechanism, one question separates the investor who holds bonds for the right reason from the one who holds them because no one told them otherwise. In episode 18, we found the concentration hiding inside most portfolios. In episode 19, how they drift without you touching them. Today, when the protection that was supposed to be there was not. I am legally required to ask you to subscribe here, so please subscribe or do not. The correlation will keep breaking either way. Marcus has spent 31 years inside institutional investment decision-making, not reading about it, in the rooms where the decisions were made. In this episode, Marcus returns to 2022. A true story. Back in 2200, managing a fixed income portfolio at institutional level, I watched something I had not seen in 40 years of markets. Stocks fell 18%, bonds fell 16%, same year. Same portfolio, the two assets that were supposed to move in opposite directions moved in the same direction. My bonds were supposed to protect me. That was the point of owning them. When markets fall, bonds go up. That is what I read. That is what I believed. In 2022, the Bloomberg Global Aggregate Bond Index fell 16%, the worst single-year decline since the index began in 1990. Here is why. In the same year, the S&P 500 fell 18%. For the first time in 40 years, stocks and bonds fell simultaneously in a major market event. Minus 16%. Bonds, 2022. The worst annual return since records began. Active bond fund managers charged 0.75% to 1.5% in annual management fees in 2022. The bond index fell 16%. The annual fee did not fall. It did not dip. It held. There is a 40-year data pattern that changes what you should hold right now. But first, if you are in acute financial stress right now, if the anxiety is too high to take even one action today, come back to this episode in a calmer moment. The mechanism will still be here. Your financial situation will not irreversibly worsen between now and next week because you chose to rest today. One action. Commit now, act next Sunday. Log into your workplace pension or ISA. Find your bond fund. Search its name plus the word duration. Short duration means under 3 years. Long duration means 10 or more. Note which one you hold. 5 minutes, one search. Do it once. Make it automatic. Then leave it to run. Bonds in an inflation crisis are like an umbrella in a flood, perfect for rain. Useless for this, and there is a name for the belief that caused this, the rate myth. Here is the complete answer. Right, quick one, 30 seconds. Stay with us. This is the part most people miss. The rule held 40 years. The crash type broke it. Back into it. Bonds fail when inflation is the problem. They protect when recession is the problem. 2022 was driven by inflation. The protection rule failed. Rising rates reduce bond values at the same moment equities fall, in 2008, 2001, and 2020. Recession-driven crashes. Bonds held, in 2022. Inflation-driven. They did not. That is the complete answer. The wrong belief, bonds are safe. They always protect when stocks fall. If stocks crash, bonds go up. That has been repeated in financial advice for 40 years. It was accurate for every recession-driven crash from 1976 to 2021. 2022 was the first inflation-driven crash in that period. The rule held until the crash type changed. What Bloomberg recorded in 2022 and chose not to widely publicize. The Bloomberg Global Aggregate Bond Index, minus 16%, worst year since records began. Active bond fund managers collected annual management fees in 2022. Fee charged on fund value, not on performance. The index fell 16%. The fee held. SPIVA Europe 2023. Tim Edwards, S&P Dow Jones Indices. 80% of active fixed income funds underperformed their benchmark over 10 years. HAMRC does not require active managers to disclose fee-adjusted underperformance to retail investors. The complexity of the bond market is the product. The fee is the service. The SPIVA Europe Scorecard, published annually for over 20 years by S&P Dow Jones Indices. Year-end 2000-2003. 80% of active fixed income funds underperformed their benchmark over 10 years. In 2022, I watched a 60-40 portfolio fall 17%. The bonds were supposed to cushion it, they did not. That was the first time in 40 years. I have not forgotten it. Here is the actual lesson, the 40-year pattern that changes what you should hold right now. Bonds fail in inflation, they protect in recession. That is the complete rule. With interest rates now above 4% in most regions, the inflation shock of 2000-2002 has eased. JP Morgan Asset Management confirmed in April 2000-2005. Bonds are recovering their historical protective role. Not zero bonds, not all bonds. Short duration bond funds under 3 years, inside your ISA or SIP. Commit now, act this Sunday. One fund, one decision. The rate myth. Bonds always protect. They do not. They protect under one condition, recession-driven market stress. Under inflation-driven stress, they fall with equities. The condition is the complete answer. If the counter moves keep getting undone in a pattern you cannot explain, that is a clinical signal. The Financial Therapy Association works at the intersection of financial behavior and psychological well-being. I do not know the answer to this yet. Did you know waiting for the right moment to invest costs you money? In 68% of historical periods. And the answer may be different from what you expect. Marcus, Nadia, Maya, Kai, auto-enrollment placed most UK pension savers in a default bond allocation without a conversation. We are having one now. Tell Marcus in the comments what percentage of your portfolio is bonds. Year and percentage. Marcus reads this week. The investor who knows when bonds protect and when they do not has made a structural decision most investors who lost money in 2022 have still not made. The bond fell because the rate rose. The fee stayed because the manager did. If the rate myth surprised you, the like is 1 second. Share with one colleague or friend who mentioned their pension or ISA in the last year. That is the only ask. 2 episodes that explain what this one builds on. Episode 18 on what is hiding inside most portfolios. Episode 19 on how portfolios drift without you touching them. Episode 21 is coming, where Nadia investigates why waiting for the right moment costs you money. Subscribe and you will be notified the moment it drops. And the answer may be different from what you expect. I spent the weekend building a duration-matched bond allocation. Balanced, tactical, thorough. The default in my workplace pension had been 40% long gilts for 6 years. Nobody told me, nobody asked. Technically, nobody had asked. That is exactly how it works.